I speak in support of my bill, H.R. 6536, the Rural Depository Revitalization Study Act. This bill requires federal prudential regulators to jointly study ways to improve the growth, the capital adequacy, and profitability of rural depository institutions, and to identify regulatory barriers to these goals in the formation of the new depository institutions. This bill also requires a report to Congress due within 1 year of enactment. For generations, community banks have been the financial backbone of rural America. They finance family farms, small manufacturers, Main Street businesses, and first-time home buyers. They know their customers personally, they understand local risk, they keep capital circulating when it's needed the most. Over the past several decades, we've seen a steady and an alarming decline in the number of community banks, particularly in rural areas. Communities, people have no access to financing or to bank services that they can go to. The process for starting a de novo bank today is slower, it's more expensive, it's more uncertain than it has been in any point in modern history. Heightened capital expectations, shifting supervisory standards, and prolonged approval timelines place disproportionate burdens on small institutions, burdens that large and well-resourced banks are far better to absorb. Research has shown that new banks often take up to 9 years to reach the financial and operational efficiency of their established peers. During that time, they face elevated scrutiny, capital pressure, and compliance costs that can determine whether they survive at all. But here's the key point. De novo banks do not fail at higher rates than other startups. In fact, they tend to fail less frequently than many mature banks. I strongly suggest the current system is simply cautious. It is overly cautious, and in doing so, is suppressing competition, is suppressing innovation, and is suppressing access to credit in the communities that need it the most. In 2018, Congress passed the Bipartisan Economic Growth, Regulatory Relief, and Consumer Protection Act. That law recalibrated certain supervisory requirements for small institutions and helped streamline aspects of the de novo process. Following its enactment, some states saw that their first new community banks in more than a decade. It wasn't an accident. It was a result of Congress recognizing that one-size-fits-all regulations does not work, especially when it comes to rural banking. The Rural Depository Revitalization Study Act is a direct continuation of that work. In other words, it asks very simple questions. Are regulatory systems working as intended for rural Americans, or are they unintentionally locking communities out of access to local banking? For many rural communities, losing a local bank doesn't just mean fewer financial options. It means longer travel distances for basic services, less access to small dollar and relationship-based lending, fewer opportunities for local entrepreneurship, and increased consolidation that concentrates risk and decision-making far from the community itself. At a time when Americans are rightly expressing concern regarding financial concentration, resilience, and economic opportunity, encouraging responsible new bank formations should be a part of the solution, not an afterthought. The Rural Depositories Revitalization Study Act sends a clear and constructive message to regulators. Congress wants a regulatory framework that protects safety and soundness while also allowing well-capitalized, well-managed community banks to form, to grow, and to serve their communities. This is a common-sense oversight bill. It's pro-competition. It's pro-rural. At the end of the day, it's pro-American. I urge my colleagues to support H.R. 6536